we were sort of going through some of the legacy concepts that includes the day types. And I want you to understand the day types. I want you to understand the basis for this stuff so you will understand what is valid and what's not. And that concept itself, labeling day types, trying to constrain the market chronologically in some time frame in discrete divisions doesn't work. There's no edge to that. There's an anti-edge to that. Our whole mantra, as well as Don Jones's, is that you have to look at the market in a bigger picture of development. It's an ongoing flow. It's not discrete. Each day is not separate. What happens the previous day, the 2 previous days, the 3 previous days, the previous week, all matter. And all of that, if you don't understand that, you cannot find an edge in trading this. You cannot find an edge trading market profile. There is no edge trading market profile. There is an edge trading auction market concept. So, let's see here. Let me catch up on my slides. Okay, I did a study on the stock market, and it's fairly up to date. I keep updating it, and I keep waiting for it to fall apart, so to speak. But it still has some validity, and I want you to be careful how you use this. You guys that have been around a while understand the limitations of what I'm about to share with you. It's going to, at first blush, seem like, oh wow, I can take that and really kill it, but you can't. you have to put this in a context. And I did a study. I took the S&P mini contracts, each expiration, and this started. I went back. I think it was into '97 or '98, and found that the high or the low of the day occurred in the first 30 minutes of trading, 48% of the time. It occurred in the first 60 minutes of trading, 71% of the time. And I've updated this a few times. All right, this is from 2005, 2006. First 30 minutes, 40% of the time. First 60 minutes, 65% of the time. And then I updated it through 2007, 45%, 63%, 90 minutes, 70% of the time. So the gist of this information is that the high or the low of the day does tend to occur in the first 60 minutes of the day with an edge. Now, you can't trade that because you don't know at 9:30 if that's the high or the low of the day, or if at 10:30 that's the high or the low of the day. So the best trades using that information, and it always has to be used in a context. There are a couple different contexts in which you can use that information, and as we go through this, I will point those out. But keep that information in the back of your head. It's still valid, and I will actually walk through the last couple expiration quarters later, and I'll show you so that you have the confidence to see that that's still working. Now that's just day session. That's not factoring in Globex. We have some clients, or we have a client that's done some work on Globex and what happens with the range in Globex. I haven't done any work on that. That's something I want to do. That's on a long list of things I want to do. I'm guessing that there could be something there. But for now, the information that you're going to get in this manual and that I just presented to you is still valid about the propensity of the market, of the stock market, those stock indices to form their high or low in the first 60 minutes of the day. Now, why would that be important to you? Or why could it be? Well, first of all, it's really important if you can use it in conjunction with other things, and it dovetails into the focus, where we want your focus to be as an auction market trader. And I want that focus to be on trying to develop your trade plan around the idea of identifying the best reward to risk trades. That's where your focus should be. I don't have some sort of gimmick that's going to give you 8 out of 10 winners. Of course, nobody does, but they say they do. But that's not where your focus should be anyway. So this fits that. If you can, 2 or 3 or 4 times a month, and actually it occurred on Friday, and I know for a fact that some of you caught that trade that I see on this list. The high of the day occurred right after the opening on Friday, so that was one of the instances where that could have helped you. Now, what's the implication of thinking as from a trading perspective? How could it help you if you get in a trade? Let's say you get in a trade at 1020. You buy the S&P futures or the Russell futures or NASDAQ or whatever, and you buy it and it's at 1020. Now, your average trader, okay, that's out there, he buys that. Let's say it goes up 2 or 3 handles. Well, he's just, he can hardly contain himself because he has, 3 points profit in the S&P, so he takes that trade off. Well, he has no idea what he just did in terms of potential. And here's an example. If you bought the S&P at 1020, and then the market sort of meanders around, and then as time crosses 1030, it gets into 1035, and the low of the day up to that point is still holding, and you're still in the trade and hadn't stopped you out. You've got 2 or 3 points of profit in the trade. Do you take that trade off? No. Following this seminar, there's no way in the world you're going to take that trade off. Why? Because you have a reasonable chance, a relatively high probability chance of having caught something close to what is going to be the low of the day. And there, in terms of day trading, that's what your goal should be. It should be to only trade in the intraday time frame when you have the opportunity to catch a substantial portion of the day's range. So when you get in a trade and you find yourself either intentionally or as it develops over time having entered near the low of the day after that first hour of trading, then you've got the best potential day trade that you can possibly have. So that's a concrete example of how these bigger concepts that may seem to be conceptual in nature do have practical application when you sit down to trade. It will help you stay in trades longer. It will help you identify when and why to stay in trades longer. And also, then it gets back to alleviating some of the anxiety that traders feel because they feel like, okay, I'm a trader, my job is trading, I sit and stare at this screen all day, I need to be doing something. Well, one of my main messages to you is that on Monday, understand the primary thing you should be doing when you're sitting in front of your screen most of the time is nothing as far as clicking the mouse. Now, you're sitting there, you're evaluating the market, but you're looking for very specific things to occur. And unless it occurs, you don't do anything. And that's regardless of the time frame you trade. Even if you are an intraday trader, you don't have to trade every day. As a matter of fact, one of the first people that I worked with when I started Alexander Trading, I met him in Atlanta. When we lived in Atlanta, I met him in a gym, and we were talking, and we just started chit-chatting, and it's one of these, well, what do you do? What do you do? That type of thing. And I said, well, what do you do for a living? He says, well, I'm a trader. I said, oh, really? So we started talking. I told him what I did. And he was like a lot of traders. He was trading, 30 or 40 times a day trying to scalp ticks. And to this day, he still trades, but to this day, what he does, and he only trades intraday, doesn't take positions overnight, which I don't think is smart, but anyway. He doesn't do that, but he only trades 2 or 3 times a week, and he does extraordinarily well because he's learned the perspective of patience, even though he is just simply a day trader. Roberto, we're going to go through a lot of examples later, so remind me, and we'll come back to that if you like. So that is sort of the importance of the information that you'll get in this manual that I have outlined. Well, let me catch up in the manual. Speaking of the manual, to get to where we are. Okay, the profile graphic and the auction market process. Now this speaks to both the labeling as well as the fractal process again. The auction process is fractal. 30 minutes is a 30-minute auction is a rotation in a day session, a day auction. An individual day, a day auction is a rotation in a time frame of a larger auction. And so what you're trying to do is to simply, I mean, if you this could be a trade plan, and actually it is a trade plan of a lot of people. You want to identify an auction in a smaller time frame than the one in which you're trading, and trade so that you have the risk of the smaller auction with the potential of the larger. And I'll say that again, and Roberto, I will show it visually, but you have seen that before. So what we want to do is to identify this auction process and not get hung up on day types and things like that. Now I want to read you another excerpt from Don Jones's book before we get going here, but and this is again, this speaks to this concept that we teach that is an extension of the work of Don Jones. But this is from his, actually this is from a newsletter that Don sends out. Back in 1985, 1986, as I became familiar with the profile concept, I believe the basic ideas: volume identifies demand, price offers opportunity, there's someone who buys the top price, someone who sells the bottom, markets move from balance to imbalance to balance, etc. I still believe day type and who is active was more mystical. Think about it. 4 day types are defined in the CBOT Market Profile Manual. Then look at the market. There are not just 4 day types of day you see. There are dozens. Obviously, the variations from type to type can take many forms and paths. The market does not go directly from one identified day type to the other. In fact, Mind Over Markets lists 9 day types. Anyone could doubtless devise many more. Probably the most damning thing my research has uncovered is the inherent variability of the day's profile itself. In other words, the rotation of the day is pretty random. It can't be predicted. 2 or 3 days of profiles may, for all the world, look like a trend, while what is happening is just rotation in a longer-term balance. I have called this the missing link in profile analysis, since without knowing the market condition, the profile cannot be unambiguously understood. In other words, you got to look at the bigger picture of this stuff. And because it's fractal, the same concepts apply all the way down the chain. Okay, the auction process is fractal. This is a visual of it. You've got these smaller auctions inside a larger auction. The smaller auctions are just pieces of the bigger auction. Roberto, we were talking about randomness earlier and noise. These smaller structure, from this particular perspective, are simply noise of this larger structure. These smaller structures themselves may or may not be tradable based on how large they are. Yeah. Emil, and if I am mispronouncing your name, I apologize. 10-day average true range is a rough measure. It's a measure of volatility, and it can give you an idea when a market is trending as to what the potential might be, the rough idea. Now, I'll also tell you that when a market is, and we'll see some examples of this, and I'll come back to this. But when a market is transitioning from balance to imbalance, your average true range will expand typically in the early stage of that transition over what it was in a balance area. Okay. What is the information here? What is this telling us? Guys? Yeah, exactly. Well, it is, balance is what it is, but what is the information from balance? And what it's telling us something about value. This is a methodology that depends on identifying value, and value is defined in a specific way. It's where the most trade activity occurs, and as a corollary, where the least trade activity occurs. So what a balance area does for you is it defines value, and where it is and where it is not are, the auction process creates these inflection points. So this is an area of least value, this is an area of least value, this is an area of greatest value, but these are inflection points. Roberto, yes. Roberto says, ask the question if trading will be noisy in the area of greatest value because it has more activity. Yes. And why does it have more activity in the area of greatest value? It's because that's where trade is most easily facilitated. I can sell or buy 10,000. Let's say this market is, 50,000 deep. I can buy or sell 10,000 here just as easily. I can't sell 10,000 here. I can't buy 10,000 here. I have to go back up into the range to do that. That's why you see less volume here and less volume here and more volume here. And that's how you're defining value, by what occurs, how much, and where. So knowing what is and what is not value helps us to define our edge. Actually, it is our edge. The areas of greatest value, the areas of least value are inflection points. That's what you're looking for. I don't know why you don't see the word points there, but you don't. Okay, key reference areas. Now we're getting into some practical things. If you're sitting there, your eyes are glazing over and going, okay, hurry up, get to the point of something tradable. Now you're there. Key reference areas provide trade location with the best reward to risk. Remember I said, in this methodology, it's not so important to know to go long or to short as it is to know when to enter the trade, where to enter the trade. And this is an example of that. If this is a mature balance area, and everything else being equal, the market trades up here, I want to take a trade. Now, there are reasons for me to be maybe favoring long trades over short trades or vice versa, but in a vacuum, there is the edge comes from identifying that I want to be trading here. And this is how I define my risk. If I go long here, it's an initiative trade, it's a trend trade, I'm expecting a breakout of this balance area, and it should not retrace back into the previous balance area by much. And I'll get it more into helping you define what much is. Same thing with a responsive trade or fading the range. If I short it here, I know the market shouldn't take the high out by much or I'm wrong. Somebody say. Okay? And when the market is trading near the high volume node in a mature balance area, the only immediate edge of the way to decide which way you want to go. Because when a market is trading here where this X is, I know with certainty that the market's either going to trade here or it's going to trade here, and potentially through here or through here. So how do I decide which way to go? Well, if I'm just basing that decision on the information I have at hand, in general, as long as price is near the high volume node, I want to be taking trades on the price side of it. In other words, if price is just above the high volume node, I want to be favoring longs. If it's just below the high volume node, I want to be favoring shorts. So this little schematic here is something you can print out. Actually, it'll be in your manual, I think. And you can, this is the general idea about what you want to do. Now, Giampolo, I think it was you. You basically stated this earlier. Because this process occurs across all degrees of time all the time, you have balance areas within balance areas. So what you want to do is identify the small degree balance areas at the inflection points of larger degree balance areas. This is the ideal trade setup. And this happens all the time. You know, the guys that have been with us, have been clients for years, will validate that, will verify that. So if you can identify a structure like this, a setup like this, what you're doing is you're taking the risk. All you have to do is assume the risk of this structure, and you have the potential of the much larger structure. Yeah, Alan Spores is the one that caught the post this, is the one that caught the Russell trade, which was an IBB trade on Friday. Giampolo, you say, but the smaller has to get an edge all by itself, correct? No, not necessarily. Because really you're just using this as a lean, as a tail. The break of this is the tail for the break of this. So the answer is not necessarily. Because this doesn't have to have the reward to risk, because remember, you're gauging your risk here. You're not gauging your reward here. You're gauging your risk here. You're gauging your reward here. Small risk, large reward, just as these structures. This is a smaller structure. This is a larger structure. What is the information here? Guys, what's the information here? Give me something that's not printed on the screen. I can read. Value is on the move. That's right. There's a market that's searching for value. I mean, it is what it is. Is this tradable? Is this a tradable structure? No, it's not. It does give you information. You know, you can objectively and accurately identify what the market is doing without it being tradable. That's important to know. All right, this is a rotation in a given day. What do we know? We don't know anything. I mean, all we know is the market is in a vertical move of some degree. Now what do we know? Well, we have more information. There's a lot of things now. There's a lot of additional information about this. Let me give you an example. Let's take a couple of hypotheticals. All right, let's say this is as it is, and the market is trading right here. Is there a trade if the market is trading right here? Potentially. Yeah, I mean, yeah, potentially, because if this market goes much higher than it has already, we just based on the basic concepts that we know, we don't want to be caught on the wrong side of this high volume node for long. So if this market now is about to transition into imbalance down, it really shouldn't go much higher than this, right? Now, if the market were trading down here, is there a trade? Potentially. Well, Michael, you say long, but it also could be a short. And this is sort of a trick question, and this gets into nuance. Because and this is something you'll be able to do. I can look at any market, and I have clients that do this all the time. They'll say, "I'm in this trade. What do you think?" And I can look at it, and I'll say, "Well," like for instance, if somebody calls me up and says, "Well, Tom, I'm in this trade and I just got in it, and I'm short," and I'll say, "Well, really, the only thing that invalidates it, based on the information we have at this point in time, is if the high of this range is taken out." And if you say, "Well, Tom, I'm in this trade and I'm long," I'll go, "Well, right now, the closest thing to an objective stop you could use would have to be below here, this previous structure." And so what you can do, you can look at the market, and if you're getting an itchy finger to trade, it gives you an objective set of criteria against which to judge the reward to risk of the trade. And you can almost always judge the risk easier, what would invalidate the trade, than you can the potential reward. So you identify the market condition. The market condition here is balance. Now, it's becoming mature, so it could transition. I could be looking for a breakout of this. And if that's the assumption I make, the ideal trade would be if I can get a trade off here. The best reward to risk trade would be if I could get a trade off here with a stop just here, just above this level. And to do that, what I would do then, I would go down in time frame, and I would see if it was setting up on a 5-minute chart or something like that, and gave me a smaller degree balance area. So you identify the market condition, and then if you're thinking about a trade, you say, okay, if I go in, if I short this here, my stop has to be here. If I go long here, my stop has to be here. Why do I think? What's the potential for this trade to go higher, and why do I think that? What's the potential for this trade to go lower, and where, and why do I think that? And this information you already have. Now, this is coming at you rather quickly, and you haven't had a chance to digest this. But you have, up to this point, all the information you need to answer those questions. Okay, we're going to do more of this. We're going to get back to this. Okay, we're going to talk about volume. This is a quote from one of Stottlemyre's books. Most important factor in any marketplace is volume. Volume defines market activity, and volume never lies. It shows what is truly happening and not just what is happening on the surface. Now, This is something that was written by Stottlemyre 30 years ago, and it is contextually still true. However, volume does lie, and volume, unfortunately, no longer always shows what's happening underneath the market. And I'll give you an example. There's an entire, I talked about the propensity of everybody trying to turn everything into magic. Well, they're trying to turn market profile into magic, and there's this huge attempt to turn volume into magic and to parse volume out into the amount of bid and ask activity. Well, the reality is, especially in the stock indices, but not only the stock indices, it's increasingly in commodities or currencies. When you see volume, that volume is not necessarily just directional volume. As a matter of fact, it is seldom just directional volume related to that contract. It is almost always part of another trade. It's a spread, it's arbitrage, it's part of this algorithmic trading. So when you see volume, you're not getting the same message that you got 30 years ago or 35 years ago. So be careful. Be careful ascribing special meaning to volume and understand it. There are tells that you can get from volume, but you can't take a bar-to-bar-to-bar approach to trying to read volume or the distance between this close and that close and volume. That's noise and it's nonsense. And there are a million reasons it won't work, and I've just described a couple of them. You have to read volume in a context. You want to read volume at these inflection points. But during the day, just this rotational stuff, you'll get killed. But understanding volume is important, but there is no magic to volume. Now, when you talk about volume, it's important that in our worldview, what we're doing, this auction process and our use of the auction process involves a dimensional view of volume. That's what it is. It's a dimensional view and a dimensional interpretation and read on volume. It's the perspective and the dimension that you get from the horizontal scale, which is what the profile graph very effectively displays. And it's also what you get on the vertical scale, which is best seen on a bar chart. And horizontal volume is created by a different process than vertical volume, and it has a very different meaning. Horizontal volume shows you very effectively where the greatest value is in a given auction or given time frame. Volume on the vertical scale can be read to determine when the market is about to transition or you've reached an inflection point and an area is being rejected or accepted. Okay? Giampolo, do we read these three key KRAs to define a balance? We'll talk about that a little bit later. But Giampolo, remember it's fractal. A balance area can be 5 minutes, it can be 3 days, it can be 4 days, it can be 5 days, and we'll talk about that. There have been attempts on the part of everybody from Peter Stottlemyre to Don Jones to be able to tell when a balance area is mature and when it's about to break. And Stottlemyre has tried all sorts of different gimmicks and tricks and can't do it. And you don't have to do it. You want to recognize the market condition and then know where to trade. And if you do that, that's where your edge is. Now, I'll show you some things and some nuances that you can use and propensities of certain markets, like in the stock market. When you have 3 or 4 days that are in balance, you're going to get a break. You're generally going to get a break. and different markets tend to have different clocks. But 3 or 4 days in today's markets is pretty universal. We've got so much money chasing the markets now. You have this all in and all out, and markets don't tend to balance too much more than 4 days, especially when they're in a larger degree phase of vertical development. Okay, this is horizontal development, volume on the vertical scale. You've got an area of relative high volume, areas of relative low volume. You've got a selling tail, a buying tail. This is 4 days. Or let me look at my notes here and see if I've left anything out. Okay, here are a couple of things. You hear this stuff about buying tails and selling tails, and those are legacy concepts that are still important. And a selling tail occurs when an area is being rejected and the market is basically run out of buyers and retraces sharply back into the range. A buying tail is also rejection. The market runs out of sellers and trades sharply away from an unfair area. When these areas are revisited, the market will typically do one of two things. It will continue sharply in the direction that was rejected before, or once again, it will reject it and trade sharply away from it. But buying tails and selling tails represent what Stottlemyre referred to as excess. And they are inflection points. Okay, now let's talk about, this is something else that comes under the category of magic. Single prints. Single prints are a key reference area, but single prints refer to the occurrence on a profile graph where you will have a market that moves sharply from one area to another area in a certain time frame, and it's coincidental, and it creates a lack of rotation. In other words, you don't have other time frames that come back and rotate through that area of the single prints. And what it is doing, it's displaying conviction. It's displaying a one-sided market. It's displaying a market that is in search of value moving higher or lower. Now, single prints are themselves an artifact of how a profile graph is constructed. And there is nothing magic to single prints. Single prints are a chronological coincidence. The market profile traders, not option market traders, the market profile traders will take 2 or 3 single prints and ascribe special meaning to that specific area. And once in a while, the market will trade right to that area and stop on a dime and reverse, and everybody's convinced, oh, see, single prints again. Well, it's coincidence. Because when you have vertical conviction, what we refer to on bar charts as an elevator shaft, you don't know. The market is going to usually retrace or test some part of that area of conviction. And you don't know where it's going to stop. You can't tell. And you don't have to. All you need to know is that it's there, and when the market trades back up into it, then you look for a minor balance area to form to make a trade decision. But single prints, the important message from single prints is that single prints are created by conviction in the market. And that conviction may be in the process of moving the market higher or lower, or looking for value higher, or looking for value lower. Single prints almost always occur during a transition from a balance area, especially breaks out of extended balance areas. And I'll show examples of this later, and we'll revisit it. But there's no magic in any of this, and there's no magic in single prints. Single prints are created through the auction process, and it's important to understand the underlying concept and what creates quote-unquote single prints. And the area of conviction is usually much larger than 2 or 3 single prints. Okay, now this is, because of the range here, you can't see but one single print. So what I've done is take this day and expand it out. And on this particular day, this is a market and a mature profile. It tested the unfair highs. And then conviction came in and it began driving the market very sharply lower. You see this L? Well, here are your single prints. But this conviction really started up here. Now, what makes this area important is that after trading down, you did have the market trade back up and test this area in here. This is where, at least in this time frame, there was some two-sided activity. But the conviction actually started up here. And this conviction. Now remember, you can't predict one day from the other. But you can predict that when you have a mature profile, the next event that you're looking for, you increasingly want to weight your strategy and your tactics towards catching the initiative move. When you see something like this and then you see the market close on its low, you have some very good parameters for the next day if you are inclined to short the market. And this is telling you, at least as of the close, the upper extreme of this balance area had been very strongly rejected. And we also know with certainty, this is not a guess, that a market will probe each range extreme and ultimately it will break. And the more mature the profile, when one extreme is tested and it holds, it is increasingly likely that the test of the opposite extreme will not hold. And this is now, because this was back in, when was it? This was back in March of '09 when the market was really volatile. The range is real wide, so this is not a tick for tick, and it's hard to tell. But basically, what you had, this was a tell, the rejection of the unfair high here, and then the conviction that came in and the market closing on its low. That was sort of a tell that the market was beginning its migration to lower value. And actually, you can see this is where the market closed on that day, and this is where it opened. So you had this gap down, and then you had a rotation back. And see how rotational this day was? So you did have opportunity to get in this market if you felt like the transition was lower. Volume on the vertical scale. All right. This is volume. What I mean by the vertical scale is more of your traditional bar chart view. And this is what I look at. I use very simple, basic things. I just use volume, just your vanilla volume bars at the bottom of the chart. There is nothing you can buy in a program that gives you more information or insight than I can get from this view. And it's not that I'm special, it's just that I realize that, and you haven't come around to that. I don't have any special abilities, trust me. There's not some secret there. The point of this is that I know if this is a wide range bar and it closes on its low, and this is a heavy volume bar, that tells me certain things. I can assure you that this is a big red bar down here. Okay, I know that. I don't need colors to tell me that. And I also know it's going to be important to see what happens following this bar, because there's a lot of vertical conviction in it. And until proven otherwise, because of this heavy volume bar that's so directional, I want to bias my trades to the short side. So if I get a setup on retracements back into this bar, I'm going to take them. And that's all I need to know. I don't have to know exactly how many contracts were traded on the bid and the ask in every single bar, that bar, and every single bar that follows it to make a trade decision with an edge. Now, one thing, and this is something that I will do, I show this, I will put moving averages on top of my volume to sort of smooth out the spikes. And this happens to be, what is this? This is December of 08. This was the momentum low of the bear trend off of the 2000. Now, prices went lower into March of 09, but this was actually the momentum low. And this is a very common thing that you still see to this day. I do see value in monitor. Now, this is 30 minutes, okay? I do see, and I do this. I do see value in monitoring lows, because typically you will get momentum lows, and those momentum lows will be exceeded by lower price lows on less momentum. And that's true across a number of different internally generated indicators, such as volume or some of the breadth work that you guys, that we all do together, so to speak. And this happens at tops as well, where you will get a lessening of volume at the ultimate price extreme away from a momentum high. Now, this is a great chart. I love this. This was the top in 2007. And this happens to be the December 2007 S&P mini contract. This was October the 11th. This was a high print. And if you look down here, look how low volume was coming into this high. I mean, it was extraordinary. This volume spike was the kickoff move to the downside. So this is a simple way to read volume. But this itself is not tradable information. It has to be viewed through the lens of an auction market. Now, what is the message? If the market is going higher and volume is getting less, what is that telling you from an auction market perspective? Yes, there are less and less buyers. Remember, a market will trade higher until it runs out of buyers. Until it becomes two-sided, it runs out of buyers, then the sellers take it back down. A market will trade lower in search of sellers until it runs out of sellers. And that's what this information, that's how you view this information. It's also how you view breadth. Now, breadth has been rather funky for months for a variety of reasons, but still conceptually, and it worked on Friday. I mean, at the top, the S&P cash made a new high, and we had negative breadth. Of course, that's occurred about a dozen times, and the market hadn't had much effect until yesterday. I mean, Friday, yeah. So you got to put this stuff into context. And the default, let me say this. The default of breadth, the default of volume, is always to the development and the structure of the market. In which phase is this market trading? And the levels that the the balance areas form, the key reference areas. That's the default. And it will keep you from getting confused and joining the 95% of all traders that lose money because the market isn't behaving by some model they have in their head about what should be happening. All right, let me get caught up here, please. Let's see. Let's see. Going through my notes, making sure I'm imparting all relevant wisdom. Okay. Now, this gets into some of the nuances about reading volume. Green is volume at highs, red is volume at lows. There are two ways that you should view volume on the vertical scale. You want to view it in terms of what constitutes heavy versus light volume and what constitutes light versus heavy volume in terms of directional move. In other words, this was selling volume here, this is selling volume now. How do the two compare? Or then, how do the two compare? And that's what this is what this example does. Now, this was January a year ago, and coming into this top, you had volume really dropping, dropping like a stone. And then you had volume begin to pick up down here as the market declined. And then on this rally, you had a pretty substantial rally, almost back or double topping, but on really light volume relative to the selling volume that had preceded it. And then again, we had selling that came into the market, and again, the selling volume was very high. So you had the market was beginning to give you information that was useful from an auction market perspective. The market traded up into January, and volume was very light. It was running out of buyers. And then when it fell off, it found a fair amount of sellers. And then it rallied again. And once again, it couldn't attract buyers in the same area that it was trading before. And it traded off. And once again, it found even more buyers. And then it bottomed and it rotated, and it could not find a lot of buyers. And then it began to trade lower, and again, more and more sellers came into the market. So, that's reading volume through an auction lens and comparing up volume versus down volume, and what are the market participants more eager to do? Are the buyers that want to buy this more eager to buy it, and are there more of them? Or are the sellers that want to sell it more eager, and are there more of them? And eventually the sellers won this in a big way. And this was really the confirmation that the sellers were taking over here. You had heavy selling following this top here. Then you had volume that couldn't sustain, and then you had even heavier selling come in. And then you had another rather tepid rally and even heavier selling come in. So this is telling you something about what the market participants feel about value. And that's how you read it on the vertical scale. That's not something that a profile graph, the profile is going to help you with. All right, Raphael, you ask a good question. Don't you get for every buyer there's a seller? Yes, but look at the range of this. You're not having participation. The quantity of the volume drops off as the market is rising, and it's increasing. So the sellers are controlling it. The market it can't go higher, but it is going lower. So the volume that's coming into the market is less, and the participation is less, and the participation picks up to the downside. And the other thing, Raphael, you have different time frames transacting in here. Not everybody is trading in the same time frame. So you've got to be careful about making assumptions about volume in that way. We sort of discussed that. Does that make sense? But that's a good question, or good observation. Okay, bar charts and auction market analysis. You guys that are subscribers and clients know that I probably show bar charts in the report and during the day more than I show a profile chart, because I'm interested in the auction market process. And I'm interested in the view that best displays that process and helps me to define my trading. And I don't care if it's a bar chart or a profile chart. I'm interested in getting the perspective and seeing what's actually going on in the market. So when I look at a bar chart, I'm always looking at it through this lens of, all right, is this vertical development or is this horizontal development? Now, this is a very pronounced trend in the S&P over a number of days. Well, this was January 2009. And you can see the market formed a balance area up here. It gaps down, it forms a balance area. It transitions lower, it forms a balance area. You get a false breakout, trades lower, forms a balance area, etc. This is sort of a microcosm of, in a few days, of the chart that I showed you of the activity that occurred in October of 2008. Now, one thing, and this is sort of, well, this is useful for me. I think the more experience you get, you will find this of use too. The market, even a strongly trending market, will form these minor pockets of balance, and it's doing it now. We'll talk about this tomorrow. We'll go through the market getting ready for next week, and actually it's at an interesting time. So I can look at a bar chart, and I can see the balance areas, and then I can see the points of high volume nodes, or the area of high volume nodes in here. And those areas tend to be supportive as long as a trend that is in effect is still valid. And we're still using that concept today. I've been telling people for weeks the trend of this market is up unless something happens. And that something that it has to happen is something objective, and you've got to have your minor balance areas taken out. And this is another example of it. Now, this happens to be, when was this? This was back in 2007. So this was occurring in 2007. It's no different than what's occurring in 2011. Exact same concept applies. Giampolo, what is a minor balance area? It's one that's not major. It's a balance area of smaller degree than the time frame you're trading. Okay, now this dovetails into the idea about the profile configuration view of a market, and then the same amount of information that's a bar chart. You know, most people that trade that use things other than market profile, auction market concepts, look at a bar chart and they look at this and it's choppy. They don't have a clue what's going on. But when you take this configuration, this is what's actually happening, and it's actually quite orderly. And there is you know, it's an elegant process that occurs all the time. Now, over time, as you learn to trade, what you'll see in here is an incredible opportunity. And you can't see it from this configuration, but what you want to see when you're looking at this, you want to see and understand that this is this. Now look at this for a minute and see if it fits, if you can identify an opportunity similar to the ones that we've been talking about. In here, what do you see? Anybody want to give it a shot? Okay, you see balance, Elena? Okay. But what else? Okay, you see balance. But now look at this market. You have a market that forms this balance area over a few days, and then it gaps down on the 27th. And what does it form? What is this? It's a balance area. And where is this balance area? It's at the low extreme of a larger structure. Does that ring a bell? Here, I guess I can leave that up. Hold on. So what this is, oops. Now this is our basic idea, right? Our basic schematic. All right, look at this. Now look at this. Pretty cool, huh? Now, this gets back to, remember we said that this is not predicted. The only thing you can predict that the market will transition and will phase, that there are two market phases, horizontal development and vertical development, and the market's constantly rotating between one or the other. That's what you can predict. And so when a market reaches a certain state of maturity, it will transition, and you want to be orienting your trades towards the initiative trade. So if I come into the market on the 27th of, this looks like March. Yeah, this is the March 09 contract. And the market is doing this, and it's a mature profile. I have a tremendous edge whether I'm going long or short. But I'm probably going to be leaning short based on the fact that the market has tested the upper extreme and it could not get through. And then a day later, it's testing the lower extreme, it gapped down, and now it's rotating. So this is a wonderful place to be trading. And if you went long here, it wouldn't be a wrong trade. It would be a misread, perhaps, but it wouldn't be a bad trade. But with experience, I think most traders would be looking to sell this, and this is why. And this is not something that doesn't occur over and over and over again. Is that right, Mr. Spohr? Are you still listening? And Elena, a lot of you guys see this over and over and over, and you trade it. All right, now this is the same time period, the same days as we were looking at the what was it, the 20th through the 26th before, and this gets more into your volume, individual volume bars, and paying attention at certain places as to what volume is doing. Now this is going to be in your manual, so if you don't follow this, it's there for you. You'll see it. Now here are the individual volume bars. Now to make it simpler, all right, here's 520 through 26, and the green is the up volume, the red is the down volume. And you can go through here and you can see that the selling becomes, appears to become more dominant. Here's buying, and you can see how the buying was on lighter volume than the selling, and the buying was on lighter volume here than the last time the market was up in this area. So the market is not attracting the same amount of volume in terms of buyers that it had before, and certainly less than the sellers. Likewise over here, you've got more buyers than here, but not as many as here, and not as many as you had sellers here or here. And then ultimately, before the market finally breaks, and it has tested this level 4 times, look how light the volume is on this attempt to drive the market higher. And guys, when you're using stuff like this, unless it's obvious, just default to structure, because you could trade this the same way without this information. I find it useful, and over time you will too. But if it confuses you, the more important thing you can do is to learn to identify the condition of the market and to view it through this auction market lens. What this is, these represent unfair highs. This is an area you want to be trading long or short. And this is a third, actually it's a 5-minute time frame. So these are minor balance areas up in here at this extreme that are themselves tradable. This is not unlike, actually this day is not unlike what happened on Friday. And I know some of you took that trade. Daniel, you ask a great question. How do you know if there's a mature profile? I hear that a lot, but how do you know when there is maturity? You don't, and you don't have to. You have to make certain assumptions. And it dictates your strategy to be able to identify these inflection points. If you trade from the inflection points, you will put yourself in a position to catch the initiative move, and the initiative move occurs outside, when the market is transitioning out of balance. But you don't have to obsess over knowing exactly when a balance, because you can't. I don't know, and nobody does know. Nobody can give you an exact definition, because there is not an exact definition of a mature balance area. Okay, now this is an important concept in trading auction concepts. We're trading market development. And in anything that has the term development in it, there is implicitly a time factor. If you are developing an office complex, it takes time to build a building. If you're baking a cake, it has to bake, it has to develop. And trading these auction market principles, you have to understand the role of time in trading. Traders, especially people that just day trade, never have large winning trades, because first of all, they don't have a basis for understanding what's going on. Their trading is random anyway, and when they have 3 points of profit, they're so excited they can't help but take it off. And what you have to understand is the role of time in your trading. And to get back to the example that I used before of an initial balance period trade, where if you had entered the market at 1020 and you're still long, let's say you bought it long, and at 1035 or 1040 your trade is still sort of meandering around, you've got a little bit of profit, but the low of the day hasn't been taken out. You need to realize, and you can only realize if you understand the time aspect of market development, that that's a trade. The hard part of your trading day to that point is done, and the most important thing you can do for the rest of the day is to sit on your hands and let that trade work. And you might not get the ultimate payoff until 4:15, because what you may have done is entered the low of the day, and you don't know what the high of the day is going to be until probably much later. But most traders want to enter a trade here and have it drop 15 handles 3 minutes later. And, that happens about once a year to you. And it's luck. And you can't trade around expecting that to happen. What is much, much, much more likely to happen is that you enter a trade here, and it goes lower, and then it rotates back up, and it comes down, and then it goes up, and then it goes down, and etc. Now, this is the type of day where a lot of traders will sell the market all day long, and at the end of the day, they will have lost a fortune. And the reason is because what will happen to them, they'll get in a trade here, and they'll sit and they'll hold it, and it will come up, and they start to get nervous, and then they come up here, and then the market starts up here, and they scratch the trade. And then the market drops, and they're afraid they're going to miss something, so they re-enter the trade here. And then they take a profit here. And then the market starts to fall, and they re-enter here, and then they get nervous, and they stop it out here, etc. And they do that all day long without understanding or without having a basis for understanding how a market typically develops and the time factor involved. So you have to understand when you enter your trade what the expectation for that trade is from a development perspective and why. And it will help you stay in your trades longer, and it will help you understand the potential for your trades. I guarantee you there is not another group of traders in Traderland that has bigger winning trades than our clients. I'm looking down this board of the people in here, and this is a relatively small number of our clients. But I know for a fact that some of you had a huge day on Friday because you caught a substantial portion, if not all, of the range in the Russell. And I think, Robin, you caught like what, 400 points in oil? I mean, So this is not unrealistic, and this is what you're trading for. But to get the big winning trade, you have to understand time. Now, another thing here, and this is just a fact. The shorter the time frame you trade, the smaller your margin of error. The shorter the time frame you trade, the closer you are to randomness. And if you are a scalper, and you won't be for long if you're a client of ours for long, because you just won't, it will not be congruent. You won't be able to do it. If you're scalping or trading the very shortest of intraday time frames, time is your enemy. The longer your time frame, the more time is on your side. And you do not want time as an enemy. Most traders, especially intraday traders, have time and they make it their enemy. And this is for a variety of reasons. You are brainwashed by the industry that you have to have rapid execution. There is this race among the brokers to sell you or to get you to buy into the idea that they have the quickest order execution. They're down to milliseconds. And I can assure you that's not anybody's problem that's making money, is worrying about a few milliseconds sitting in Des Moines, Iowa in their boxer shorts trading the S&P futures. A few nanoseconds is not going to help that person make money or not. All right, Daniel, let's see. Days like Thursday, where it went down 10 points from pre-market, then back up, then down again, back up, and even surpassed on Friday morning, only to drop again Friday. How do you manage stops so you don't lose all your profit from a 10-point drop? There's too many questions in there to answer at this point in time. Some of that's probably going to be answered over the next day and a half, Daniel. And some of it gets to understanding the market condition and what potential the market is providing based on that market condition. I mean, 10 points is nice. It's a lot. But if the potential for that trade is realistically a multiple of 10 points, then having it retrace is just not that big a deal, is it? So it gets back to this very thing. It gets back to understanding time and understanding market condition and understanding the potential for a trade. And different trades have different potential, and we're going to talk about that tomorrow afternoon when we're analyzing the markets for next week. But there's not one answer for that, Daniel. A lot of it depends on the market condition. That's going to dictate your strategy, your tactics, as well as your money management. There's not one money management application for all situations. Okay, guys, let's take about a 5-minute break here. I want to get something. I'm starting to lose my voice a little bit. All right, we're going to spend some time talking about something that is specific to the stock market. And it's coming at an interesting time because I have used this almost all of my career. I've used it well over 20 years. I've been trading. This is my 26th year of trading, and I started using this in the late 80s. I started using Brett. And it tends to be tricky to use, and it can be confusing. And I'm going to give you a sort of a down and dirty, well-chosen examples of how it works. But again, I want you to always, I don't want you to take the things that I'm showing you today, like volume and this stuff, and think there's magic to it. It has to be put in a context. And if you default to market structure, you can't go wrong. So I really want to emphasize that. There are times where volume can be deceptive. Volume on the vertical scale can be deceptive, and breadth can be deceptive. And we're certainly one of those times where breadth has been deceptive. But I'm going to share it with you. And it is useful. It can be useful in a context, but everything has to take a second seat to these auction market concepts. So, all right, this is breadth through the lens of an auction market. And let me define breadth. Breadth is New York Stock Exchange advancing issues minus New York Stock Exchange declining issues. And I plot the difference as a graph. And you can do the same thing with the NASDAQ comp, advancing issues and declining issues. As a matter of fact, I do that. I plot them, and I can show you this. I'll show you this later today, or I'll show it to you tomorrow. But NYSE breadth and NASDAQ comp breadth mirror each other almost perfectly. That used to not be the case, but it has become such an institutional-driven market where everybody pushes the buy and the sell button at the same time. Everybody's chasing the same algorithmic tail, so to speak, that these indicators, it's uncanny how highly correlated they are, just as the correlations among and between assets tend to be extraordinarily high, especially when the market is moving vertically up and or down. Now, that being said, you look at breadth differently when you're in a strong bull trend than you do when you are in a strong bear trend. When you are in a strong bull trend, what will happen with breadth is that it will tend to have a personality, as all trends tend to have a personality. Well, breadth, along with the trend, will set a personality relatively early in its development. And what I mean by that is it will set a level that is oversold. And when it reaches that level, you will tend to be near short-term lows. And when you're near short-term, when you get a breadth reading that has defined that the trend itself has defined as being oversold, and it's into a key reference area, it can be extremely helpful information. And actually, we're there now in the stock market. We'll talk about that again tomorrow when we're reviewing the market. This is a example. This is a bull trend. This was when was this? This was 2007. In the spring of 2007, when we had quite a strong run, ultimately up into the October top. But this was the spring, and you can see here you had you'd have the market that would make it would form these minor balance areas. It would break higher. Then you would have another balance area that would form that would contain some retracement. That retracement would also contain a breadth contraction in the neighborhood of in this instance, negative 1800 down to negative 2000. The market would bottom very quickly, and it would be off to the races. Now, also, if you notice, in a bull trend, you'll get an expansion in breadth, and then you'll get divergences. And these divergences can go on for days or weeks in some cases. And we're in one of those situations now where the divergence in breadth has been relatively historic in terms of its divergence. But it has, so far at least, and we're going to find out by the middle of next week, it has defined the lows very accurately per the form sheet of the past. Now, in a bear trend, you read breadth a little bit differently. What happens in a bear trend is that your overbought readings tend to occur very close to the same time that price peaks occur, and the market turns very quickly in terms of time, and within not far in terms of exceeding the price on which the momentum peak was made. And then the oversold readings don't create the bounces that the oversold readings occur in a bull trend. Now, this is something that I use less and less because I'm finding it of less and less value, quite frankly. But I do keep it, and basically all it is are moving averages of advancing issues. It's not breadth. It's just NYSE advancing issues, and I put a 3-day, 5-day, and 10-day moving average on them, and to get a rough gauge of overbought or oversold. It has not been effective, particularly lately. I'm mentioning it because it's going to be in the manual you'll get. I still look at it, but I can't, quite frankly, I can't find any edge in it, and I don't look at it every day. So it's going to be in your manual, so I wanted to explain it. One thing though that does hold true, and this is true of most internal indicators, volume, breadth. When you get an extreme reading, you have to be careful that it's a kickoff to a move in that direction that is going to follow through. This was in 2007, March of 2007, and the extreme reading here on a 3-day basis was not exceeded. Was never exceeded all the way into the October top in 2007. And likewise, I think you'll find that if you were to go back and put this study on the 2008 decline, the extreme reading, 3-day reading that occurred in that time frame hasn't been exceeded since. So the extreme readings can actually be kickoffs to bigger moves. You got to be careful with that. Okay. All right. Now this is an example of breadth, and you had this kickoff move here on March 21st, and then you had the market come down and form a low. You get quote unquote potentially oversold, and it does this thing. Now, the point of this: don't use this stuff in a vacuum. It really is a misuse of the information. Always, if you can't put this in the context of these auction market principles and the development that you see on the profile graph and the bar chart, then don't use it. Only if it helps confirm that should you use it. Okay, 1 second here. All right, this is that March time period that we're talking about over here. This is the breadth stuff, and this is the decline into March 9th, March 12th, and then you began a rally. And here is volume that occurred. This is volume on the horizontal scale. Now, on March 14th, the market bottomed, and it closed near its high. Now, if I'm trading, and I'm trading this market, and I see this market do this, and it's been in a downtrend, it looks like it's transitioned out of here. There are two areas, well, actually there's one area that I really want to watch. The downtrend is invalidated if I get back through this high volume node. Now, this high volume node also includes the upper extreme of the selling tail and the high volume from the 13th. So that's what makes this level important. So if I'm trading on this day, the best trade I can find is if the market trades up into this 1415 to 1417 area. I want to take a look at it and see what's going on at that point in time. Now, this is an example of, this is a 120-minute chart, which is the chart that we show. We sort of use as a basis time frame for showing breadth and volume. And in this particular time frame, you had the market attempt to break lower. It could not do it. It formed a buying tail and had a divergence in breadth. Stuff like this, it can be fantastic if you're paying attention to it. So you've got to put this in the context of this. This looks like it is an initiative move. You know this is an important low. So if the market is trying to go lower, it should find more sellers, right? Well, this is telling you it's not finding more sellers as measured by breadth. It would also be interesting to look at volume in here too. Now you'd want to see heavy volume here because that would indicate buying volume off of this low. Okay, now this is back to the profile view of this period of time. You have the market bottoming here, and then you begin to have the market migrating higher in terms of the value of the high volume nodes. The high volume nodes are what denotes value in a given time frame. Now we've got 3 volume nodes higher, and we back up into now we're back into an inflection point. So what happens here is really, really important. So we come into the 20th, 21st. We're in a key reference area, an inflection point, and we don't know if the trend is up or the trend is down, but we're at an inflection point, and we want to see what's going on and what's going to happen here. Okay, so what happens is now there's a lot of information on here. Let me do something real quick. Bear with me a minute. Okay, I'm on my last slide. Hold on a second. Okay, anyway. So, the market, now we know, this is sort of the micro look of what's going on. We know the market has migrated off of this low. We had a divergence in breadth. We had a selling tail that occurred, and most probably we had positive volume during this day. We had a market that reversed and closed near its high. Then we had follow through the next day with value continuing to move high, and we're back at a previous high volume node, which is an inflection point. So the move out of here is something we want to be paying attention to and hopefully catch. And then you come in on March 20th, and you can see here the market tries to trade below this high volume node. Now, if we could expand this, we could see a really great trade. And what would this be? Look, this is the low extreme that is occurring in the first half an hour, and it's tested somewhere in that second half an hour. And I know that because C is from 10 to 10:30, B is the first rotation. So this is an example of you may have had the opportunity to catch that initial balance period low, and in doing so, it was defined further than just a rote statistic of the propensity of the market to form its high or low in the first 60 minutes. The opportunity was further defined by where the market was trading and the fact that you had a bigger picture piece of market structure against which to lean and to help you determine your reward to risk if you were entering a trade down here. And here's your key reference area coming into the day. Okay, I have got to change my slides, so bear with me a minute here a second. Hold on a minute. I seem to be, hold on one second here, guys. I'm missing something. The last 4 or 5 slides of this are for some reason missing in action, but that's not necessarily, let's see, go back here. Okay, hold on 1 minute here. Well, that is substantially the message there, is using these internals along with the development and defaulting to the development to identify the opportunity. Now, if you go back to the 20th and the 21st over here, let me see if I can find it. Yeah, here we go. You had this big expansion in breadth coming out of this area. So that would have helped you confirm here. And intraday, as you were trading this, and you guys know this, something that I watch intraday is a 1 minute chart of the direction of breadth, if it's expanding or if it's contracting. And generally, almost without exception, on these wide range days, you will have breadth that will begin trending higher. And if you are an intraday trader, here, I'll show it to you, actually, because I don't have this in the manual. Okay. Now this is a 1 minute chart of breadth. This is tick up here, but we're talking about breadth. And so if I'm trading on Friday, and actually this actually happened. Hold on a minute. You don't see it? Wait a minute. Oh, I don't have. Sorry. There you go. Okay, so if you're trading on Friday, and this is Friday from here over, and this is a 1 minute chart of breadth. Now on Friday, the market, at least the S&P, it might have been more than the S&P, made a higher high, and it did it on negative breadth. And then breadth quickly began trading down. Now, at a minimum, if you watch this, you would not have been trying to take long trades. If you were taking long trades on Friday, that's a no-no. You had no business on Friday attempting long trades. The slope of this, I mean, this is a classic trend day down profile in terms of personality. I mean, I'm using profile in the context of personality of a downtrend day. You had negative breadth all day long. It bottomed relatively early and then flatlined. And you'll get the opposite of this on big expansions. So this is something that is useful in terms of breadth. You want to be paying attention to the trend of breadth intraday. And Friday was a classic example. Sometimes this is more useful than others. If you get in a real neutral day with a lot of rotation and breadth is sort of waffling around, it's not particularly helpful. I think breadth is probably most helpful when you have days with conviction, because it will keep you out of trouble and it will keep you from trying to buy a falling piano all day long. Okay, now I'm going to stop this for a minute. And let's do this. Okay, now we're going to start talking about putting this together and what's practical and what can you begin immediately to apply here. And I talked about this slide earlier in another section. This is the basic schematic, guys. I mean, there's a lot of information here. If you can just learn the nuances of this, you can be any trader that reach any level of success you can possibly dream of, just by understanding this chart. And I've given you, up to this point, all the information you need. If you go back, and you guys will have this recording, that you're going to need to trade this and to make trade decisions. And we're going to refine it for the rest of today and tomorrow. But this is it. It's right here. Now, the profile graph creates inflection points. And there are basic key reference areas in a given balance area. In the basic key reference areas in a profile unit, you've got the range extremes, the high volume nodes, and then single prints and or high volume rotations. Now, this includes, now, the key reference areas in front of you include all of that except the single prints or high volume rotations. We've talked about that, and we'll talk about that some more. But these are your primary key reference areas in any balance area that you're looking at in any time frame. And this is what you really need. You must have in some time frame you're trading to determine an edge and to define your risk and to know what your potential reward is and why. So the key reference areas in a profile unit is the upper extreme of the unit, the lower extreme, and the high volume node. Then other key reference areas include single prints / high volume on the vertical scale. Another extreme that's always important, and we'll talk about this, and it applies to a lot of markets right now. When markets are trading vertically, the previous days, like if a market is trading, when I say vertically, a market can obviously be trading up vertically or down vertically. So let's take the case of a market trading up, vertically up. It's in vertical development up. The most important key reference area, and usually, sometimes, the only key reference area, are the extremes of the previous day, meaning the previous day's high volume node, the previous day's low, and include in that the second day back's high volume node and low. And it's the opposite if you're in a downtrend. It would be the previous day's volume node, the previous day's high, and the second day back's previous day high volume node and high. So when you're in vertical development, you don't have much to lean on that's counter trend. And the most important thing you can have, and actually it's a lot of information, I'll show you some examples, is the previous day's low or the second day back's low. And those usually, one of those two will usually hold on a retracement as long as a market is remaining in strong vertical development. Okay. All right. This we've already seen a couple of examples of this, and this is maybe the most, everybody wants a setup gimmick. This may be the most powerful setup gimmick, and this one actually has an edge as opposed to some of the nonsense that's out there. Daniel, I'm sorry, I had the microphone boom over my head. I took a sip of coffee and moved it out of the way. That's why I faded out. Sorry. But this is the idea, guys. You want to use this auction process to identify trade opportunity where you have a small amount of risk and a large potential gain. And the way to do that is to identify the smaller degree auction that's trading at an inflection point of the larger degree auction. Okay, now another common question that I get from traders is how do I know, how do I know where to start? How do I know how many days to combine? Where do I start? I don't know. Well, it's easy actually. When I'm looking across markets, and you guys that get my reports hear me do this every single day. I'll look at a dozen different markets, and in 30 seconds, I can tell you this market is trading in this condition, and I can say this market has opportunity, or this market doesn't. And the best way to start is to identify a market and identify one of two things: if it's clearly in balance, or if it's in a vertical trend. That's all you have to do, because most of the time a market is in one of those two things. And if it's not, if you can't tell, then go find a market that you can. But most of the time, you can look at any market and see if that market is in vertical development or horizontal development. And depending on which condition the market is in, remember, making a trade, analyzing a market, the first question that has to be answered is, in which phase is this market trading? Is it a condition of development, or is it a condition of horizontal development or vertical development? Then the second question is, how mature is it? Or how mature do I think it is? That's a judgment call. But the first question is this market trading vertically, or is it trading horizontally? Because that gives me a lot of answers about whether or not I want to trade it and how to trade it. You trade markets in vertical development differently than you're going to trade markets in horizontal development, or you're looking for, you're using different strategies. So let's take this market. We're going to sort of do a case study. Now, keep in mind a concept, and this is a legacy concept that's still valid, that's very helpful, and we use it a lot. Let's review the steps. Somebody tell me the steps of market development. What are they? Somebody. One, two, and three. Yeah, that's great. That's exactly right. The steps are 1, 2, and 3. That's the best answer I've ever had, Alan. Yeah, okay, that is correct. Step 1 is a phase of vertical development, directional phase of development. Step 2 is a stopping price, and step 3 is development around that price. So that's what you're trying to identify, and it sort of gives you an idea about what you might be looking at when you're viewing a market. And this happens to be the S&P, but it could be corn, cotton, pork bellies, the Swiss franc, the euro, gold, silver, whatever. Okay, so this is July 18th, 2006. This is a bar chart, obviously, and it looks like if we're looking at this market at the close on July 18th, it looks like, this is an interesting area, this 1220 to 1230 area, and it looks like we spiked down into that area, and that area was rejected. So maybe I'm taking a look at this market, right? Excuse me. So this is what a bar chart, this is a bar chart view. This is July 18th, 2006. This is the profile chart. Now I have split this out. So essentially what you're seeing here, each one of these letters is a day. So this view is similar now to this view, okay? The market comes down on July 18th. And then what we have here, a step one begins. Now it includes some retracement, but remember it's a fractal process. But generally this market is vertical with the exception of a day and a half into July 27th. And then we have potentially a stopping price. We have an inside day that occurs. And this is the composite of those 3 days, 14th, 17th, and 18th. Let's go back. This would be clearer if you had, when you get your manual, you can spread this out and you can see it. So this is July 18th, and this is July 14th. This is a Friday, evidently. 17th, Monday, Tuesday. So you've got this, you do have a profile that forms down here, and here it is. July 14th, 17th, 18th. Okay, now we're going to go through a little case study, and this is one of my favorite studies. This is a bar chart of the Dow Jones Industrial Average from 1964 into the mid-'80s. And if you're looking at this chart from a chartist perspective, it's just it's range-bound trading for decades. And this is a well-known period of time that's been studied from every different angle. And this is the bar chart view. All right, now this is the same view. This is a profile view of that same information, but it's basically put on its side. And I do this to sort of highlight the concept of you want to be trading on the price side of the high volume node. So you want to be skiing downhill, so to speak. So if the market is trading right here, it looks like it might be about to go lower, so you want to be skiing downhill. On this side, you want to be skiing down this hill. Now if you turn this back the way we typically view it, you would be favoring shorts over here, you would be favoring longs over here, because that would be the path of least resistance. So when you hear me talk about when you have a mature balance area and your edge, if you're trading near the high volume node, really the only tell you have, the only edge you have, is to favor trades on the price side of the high volume node. And this is sort of the visual of that. And here it is. Now this is a slice of that decade-long period. And this is also quite a mature profile. And this is the period of time from January 1982 through July 1982. So this is a 7-month period of time. That's a slice of that much, much, much larger degree time frame. So this right here, okay, this profile, this is the 7-month period of time you see here, is just noise in the big picture of what's happened for the past 16 years in this profile, over a decade and a half. Now this is the January through July 1982 composite. And this is August of 1982. And this is the midpoint of the January, July. This is a legacy concept, the point of control. This is about the only time you'll ever hear me refer to this, because in this particular instance, this happens to be right at the midpoint of the high volume node. There is no such thing as a point of control, by the way. That's yet another attempt to ascribe magic to the market. Okay, so we know this is a mature profile. We know that this profile is occurring in a decade and a half long mature profile. And this is the August of 1982 profile. Now, when we have a mature profile like this, what are we looking for? We're looking for transition, right? We're looking for imbalance. Now, this is a 7-month balance area, and we're looking for imbalance, right? And if we look at 16-year balance area, we're certainly looking for imbalance out of this. So we have a very, very long-term profile that's in balance, and then we have an intermediate-term profile that's in balance. And so this is August of 1982. So we come into August of 1982. This is the first trading day of August of 1982, the second trading day, etc. And the market begins to trade to the downside from this high volume node, and it trades lower. And this forms a balance area down here. If we were to take these 1, 2, 3, 4, 5 plus days, and we were to take the individual rotations, in other words, the 30-minute, each one of these is a day. If we were to make each one of these, into their individual profile units, you would have a nice Gaussian profile down here. You would have this look down here. And so when this forms, we have what we've been talking about and what we've seen numerous examples of. What we would have down here would be an opportunity that would be jumping out of our skin for, because what we have is a balance area that's formed at the low extreme of a larger degree balance area, right? So we have the risk of this structure and the potential for this structure. Now, something else, and this is very important, and it's one of the, I don't know if it's, I guess it's one of the discoveries that I may have made. I'm not aware of anyone else that has said this before. I've got to be careful with stuff like that, but I really don't think anyone else has published this or noticed it. But when you have a market that is in a position to trade initiatively, and it attempts to break out, it begins to transition into vertical development, and it trades into the extreme of the larger degree balance area. If that initiative trade can't continue, then it is uncanny, regardless of the market or regardless of the time frame, how sharply it will reject that area and trade through the other extreme. And it's one of the best trades and the highest probability trades you can take. If you see a market fail at an extreme of a mature balance area and begin to trade back through it, it is one of the most rewarding and highest probability trades you can take. Now, this is an example of that, because in this particular instance, the market failed here. It formed a balance area. And regardless of whether you were long or you were short, you had to get out of the trade if you were short when this market broke and started trading initiatively back to the upside. And this market retraced in a fraction of the time the entire range of this previous area. It retraced it in a fraction of the time. It took 7 months to create it. It took about a week to retrace all the way through it. And then when it retraces it, it comes up here and it forms a balance area, another balance area. Now, the fact that this market failed to follow through in an initiative manner down here makes it incredibly probable that this market will break to the upside out of this balance area. Now, again, this happens in all degrees of time all the time. And this gets back to, we don't predict, but there are certain things where you can line up the probabilities and you can make an assumption based on probabilities. That's very different than predicting. You also know when you're wrong. So if I have a strong feeling that this market is going to break up, I might that strong feeling may manifest itself in a more aggressive position. But I know that if it breaks to the downside, I've got to get out of the trade, and I know where to get out. So I can measure my risk, but all trades are not alike, and it allows me to identify trades that I may want to weight more heavily because of the probabilities of the trade working and or because of the risk reward is greater. And this is one of those situations. And this is what happened. Now, I realize that this is sort of it may seem like a wild, exaggerated example, but it's not. This happens over and over and over again in all markets. It is just uncanny, and it happens on the smaller degree time frames. So understanding market development will give you an edge because you'll be viewing the market from a perspective that enables you to understand what is happening today is just a piece of larger market development and not a discrete random event. And quite often, because it's just a piece of a larger puzzle, you will be able to make sense of market movement that others can't. Now, you know, we're all going to get fooled by the market some of the time. You can't avoid it, but you're going to be fooled far less often when you understand the underlying purpose of the market through the lens of an auction market process than in any other form of analysis. So it's a robust way of viewing, analyzing, and trading markets. The concepts that you're seeing in this seminar that are in this presentation and that are in the manual receiving are consistent and objective across all markets and all time frames. Now hold on a minute, I want to show you something. This happens to be a monthly profile of Walmart that I've combined. This is the trade activity in Walmart from January of 2099 through present. So Walmart has been in an extraordinary long phase of vertical development. I'll just go through these different charts. This is Cocoa. This is a weekly chart. This is January through July of 09. This is July of 09 into January of this year. Now, Cocoa may be beginning an initiative move, but look at the auction process that's in effect. This is cotton. All right, cotton formed a balance area for 10 years, and now it's breaking out of that balance area, and it's in an initiative phase of development. Back to the present. This is the Canadian dollar. Now, this is a market that we're eagerly and anxiously monitoring for opportunity because it may be breaking out of a long-term area of unfairs. You know, value appears to be migrating higher in the Canadian dollar. Here's your high volume node, your high volume node, your high volume node. Now this level, we also know this level is really important. This level needs to hold. If it doesn't hold, then maybe you've got a false breakout and you're going to get an extraordinarily sharp move all the way through this range. You can go back and look, and those of you that take the reports know this. I was jumping up and down talking about silver for months, being in a balance area and that you were going to get a sharp move. And sure enough, we got that sharp move last year. All right, this is another market that we're watching closely, the Australian dollar. This is the last quarter of 2010. This is January this year. The Australian dollar is going to move initiatively. It is trading at the midpoint of trading for the past several months. Now, this is Apple. Now, I purposely did not put Apple in a profile configuration because I wanted you to see that you can see this information. And this, you know, when I'm looking at charts, I don't put it in a profile. I pull up a bar chart. And you will be able to train yourself to see the balance areas the same way I do. But if you look at Apple, you have numerous areas that form balance areas that were nicely tradable. And even in vertical, this is vertical development, but you still have balance areas that form in smaller degree time frames that enable you to make a trade decision whether you want to short Apple or buy Apple. Now, 300 needs to hold an Apple. I can look at this chart and tell you that. Okay, this is feeder cattle. It doesn't matter what market you're trading in. These concepts apply. They're robust across all markets and all time frames. Now, I'm showing you this for a reason. I know a lot of you trade across different markets. Some of you, not so much. But we encourage all of our clients that if you're going to take advantage of what this methodology offers, what it really offers is an extraordinarily robust view of the markets that you can use to derive an edge regardless of the market. So the focus is not on fixating on one market in one time frame, and you find yourself for months on end trying to pound a square peg into a round hole. Instead of focusing and fixating and getting obsessed with one market, look for opportunity. Which market is in balance? Where is the opportunity? I could show you charts of sugar, crude oil. The list goes on and on and on. This is just a small sampling of what's available to open your eyes. So guys, we are actually at a good stopping point. We're going to start with strategy tomorrow. So in spite of our interruption, we're pretty much on schedule. But at this point, if you have any questions, I'm happy to stay if you want me to expound on anything that we've been talking about. Giampolo, you asked, so do you make any difference between balance and mature balance other than on a daily time frame? Well, yes, is the short answer. You're always trying to identify balance, and if you identify balance, if you can identify balance regardless of how mature it is, the inflection points, regardless of how mature it is, alert you to where you want to be paying attention. And that's true whether it's a 30-minute balance area or a 3-day balance area or a 3-week balance area or a 3-month balance area. Raphael, you ask, do you find that volume always increases when the market drops? Uh, I can't give you a good answer to that. The short answer would be no, because I really haven't studied it enough to give you a good rigorous answer. My hunch would be that it at least increases initially. This is yes, Giampolo. Giampolo asks, is a well-defined high volume node an indication for the mature balance? Yeah, it is. That's a general guideline. Giampolo, you say, somewhere you said to trade time more than price. What do you mean? Just be aware of time and what, when you're entering a trade, if you have if your expectation for that trade, you may need to be patient. If you enter a trade at early in the trading day in the S&P, for instance, be aware that the potential for that trade may not be reached for hours, if not until the end of the day. When a market is moving rapidly, that's a form of a time tell. Markets in vertical development are moving rapidly through price. They're in vertical development. It's a one-sided trade. Markets that are sort of, rotating, not going anywhere, those are markets that are in balance. Giampolo, I'm not sure I can answer that. If a market moves sharply from unfair high, why responsive trades need more time to develop? Well, part of the reason would be is a responsive trade may need more time to develop, because if you sell an unfair high, your expectation is a rotation through that range, and that range represents an area of a lot of value. So if value has not changed, unless the market is about to transition to the downside, then you're going to have trade facilitation through the range. And you're not going to have a lot of sharp movement. So you're going to have a lot of backing and forth and small balance areas forming as it rotates through the entire range. That's the closest thing to a good answer I can give you. Guys, anything else? Okay, well, we will start again tomorrow morning at 9, and we will carry through. And tomorrow afternoon, Harris is going to present a few things, and then we will wrap up in the last hour. And what we will do in the last hour is to give an analysis of the present markets, and we'll look at the stock market, we'll look at a couple of other markets that may be setting up, and we'll certainly answer any questions that you may have. So you guys have a great evening. Thank you, and we will see you in the morning. Thank you, Skip. Alan, have a nice ride in the morning. Okay. You guys have a great evening. Thank you.